So a bank rec is performed by the company at the end of a period, typically a monthly period, so that we can, as the company, get information that the bank has over this period. So this is information that the bank has: interest revenue, any notes they've collected on our behalf, subtracting off any service fees, and subtracting off any sort of overdraft fees, any not sufficient funds check. That's what NSF is. So if one of our customers doesn't have, they pass us a bad check, then interestingly, everyone gets put upon by this behavior, because the person who wrote the bad check, they get charged. The company who presented the bad check to the bank, they get charged. So there is not only, oh crap, I thought I recorded this check, because I got the check, I recorded it as cash. But then not only do you not have that amount of money, but the company will also charge you a fee on top of that for that money. So I want us to kind of just really think through how this works. And for some reason, bank recs, they scare people. I don't know why. I think it's mostly that they don't understand what's going on. They see a formula of some sort and they're like, yeah, that's my winner. It's not going to help you if you don't really understand. So let's think about that NSF check. So a customer writes a bad check for $100, and this a little bit less prevalent than it used to be, because God knows we don't usually, and few companies ever accept personal checks, and so it's less, but still it serves a point in terms of figuring out how this all works in the bank rec with the bookkeeping that's underscoring it. So when they write us a bad check, let's say that's on whatever, we'll use today's date, which is the 28th. Geez, June's almost over. So it's the 28th. On 6/28, that means what we would do is debit cash 100 and credit, we'll just say, service revenue, because we performed a service for them. Who knows what it was, but we don't have to worry about cost of goods sold and inventory. So we record this because we assume that this check isn't bad. I mean, how do we know? We don't know this customer's account. They gave me a personal check. I believe, I'm taking this as payment for my services, so I'm counting it as cash. Then that means it's entering into my accounting system. It'll be part of my book balance. So this ending balance, it says what the banks and the books think they know, right? This NSF check is in my cash balance, because I call it an ending balance, but I'm not specific here. It's the ending balance for the cash account. And so it's in my cash ledger, but when I reconcile, I look at something that the bank sent me, and they're basically saying, hey, this guy didn't have the funds. So I need to subtract out the NSF check. I need to subtract out $100 of expense. And maybe they charge me like a 2% service fee on top of that for depositing the customer's bad check. And I know it's a real shit show. Banks win on both sides. Not only does the bad actor who doesn't have enough money in their account get penalized, but the person who gave the benefit of the doubt and said, oh, I'll take your check and give you services, they get penalized too. So after the bank wreck, now we have to make some adjustments. And we find out, well, you don't have that amount of cash. And by the way, we're charging you. We would have a service fee. And I just, I called it 2%. So let's just use that. I'm not sure what penalty they would put on it. And then we are out cash. The original amount that we thought we had needs to get reversed. So we're going to credit $100, but then we also have that service fee. So it's going to actually be $102. And now we have a customer who we thought paid us, they need to pay us, and they haven't yet. So that becomes an account receivable. So that's the journal entry side of what gets updated when we do a bank rec. Oops, sorry, I put these in the wrong way. The accounts receivable are going up, but cash makes assets going down. Credit to cash makes assets go down. And a service fee would just be an expense on the income statement. We get some interest revenue. Maybe we don't know, like, we're at the end of June and we've had this account open at the bank and it's getting maybe 1% interest per year. Well, and that interest is based on not, that I had X amount at the beginning or X amount at the end, but the amount that I've had throughout. So I won't know exactly how much interest revenue I've gained during the month until the bank tells me. And to record that interest revenue, I would debit cash, credit interest revenue. So the cash obviously is an asset. Interest revenue is one of those other income expense items. An overdraft fee, it depends. Remember, bank overdraft, it just depends on whether or not we have an offsetting account. If we have an offset and we have an overdraft, I'm going to write it up here because I don't have enough room down there. I'm starting to run out. If we have that overdraft protection, then we just credit cash and we could debit again you could be really specific, overdraft fee. You could be less specific, some sort of a service fee. And that would be lowering our net income, lowering our cash. If we don't have that compensating balance, then we need to do it a little differently because it's reported as a liability at that point. It still is an overdraft fee, but now we're creating that current liability. We'll just call it overdraft liability. And this is why, again, and so many of your 3,000 level professors, maybe even some of your 2,000 level professors have said, don't memorize stuff. Don't memorize account names. You need to know the account name, but you should know more so what the story of that journal entry is, because then you can easily change the names of the actors, but still have a similar story. What's the story here? Well, I have something that's reducing my net income and it's creating a liability that I have to pay off in the future. It's a future obligation. The names will change, but the elements, debit expense, credit liability, debit expense, credit asset, right? Those don't change. If a bank collects a note for us, then it debits cash, credits note receivable. if their service fees are just debit service fees, credit cash, book errors. So this is very dependent. Like the journal entry I'd make here is dependent on what the nature of the error is, and we'll look further at that later. There doesn't tend, well, it tends to be something along the lines of an account receivable and a credit to cash, or a debit to cash and a credit to a receivable, or something like that. But it really does, it's very contextual at that point, how we made the error. It might be that, for example, if the error is recorded a check written for services already rendered, or already, rendered. I can't dumb that one down. So if I've already done my work, right, I've already rendered my service to the customer and they give me a check, then I would debit cash and credit service revenue. And maybe I recorded that check for 870 because when I was typing it in, I just typed it in that way. But the true amount of the check was 780. Oops, right? So how then with this bank reconciliation would I alter that? So this is the mistake. I don't have to undo the whole thing. I just have to set it to rights where I credit cash by the difference between them, which is $90, and debit service revenue for 90. And the reason why I said, well, hey, this is contextual, is if I got a check for services I have not yet rendered, right? Well, then I would have debited cash, credited deferred revenue. And then the adjustment would be a debit to deferred revenue and a credit to cash. So you just have to be a little on point about some of those entries that we talked about in chapter 1, corresponding to, have I recorded a revenue? Well, I can only record a revenue when I've received some sort of consideration and I have also earned it. If I haven't earned it yet, then I can't call it revenue. It's deferred or unearned revenue. So that's all of the things we can adjust on the books. And these are the only things that we would create journal entries for. The rest, this stuff over here, is how the bank adjusts itself. This is the stuff that the bank knows already. It's already in their ending balance. This is the stuff that is already in our accounts, but the bank doesn't know about yet. So deposits in transit, we know we've made these deposits. We have gone to the bank, right, and made the deposits. We debited cash when we received those checks, and then we put them into the bank. But if they're still in transit, that just means that the bank has not yet processed them and put that amount in our balance. So then our balance will increase as the bank processes those deposits. Outstanding checks, these are checks the company wrote but not yet cleared. So we wrote a check, let's say, to one of our suppliers, who provides us inventory, but they haven't deposited it yet. When we write that check, we debit maybe accounts payable if we bought those things on credit, and then credit cash because we're writing the check, we credit cash. So our cash balance will be less. It is in this already. It is in the balance per our company's books, but the bank has not yet subtracted it. So there is a problem here that I'll work through somewhat quickly.